You are watching a market that no longer behaves like a market. It is February 2026. Gold trades near $5,000 an ounce. Silver, after violent swings, holds in the mid-70s, still up dramatically year over year, still shaking off margin shocks and liquidation waves. Volatility is extreme. Moves that once took years now unfold in days. This is not normal price discovery. This is stress. And the signals forming beneath silver are the kind that appear only at the edge of major regime changes. There are moments in financial history when the numbers stop being numbers and start becoming warnings. The late 1970s, the collapse of Bretton Woods, the Asian crisis, the global financial crisis. Now we are approaching another such threshold. Because silver is not just moving, it is behaving in ways that suggest something deeper is breaking. Now we need to talk about the signal that most people are still missing. The broken signal is not the price itself. It is the relationship between prices. In a functioning system, markets move according to predictable relationships. Growth strengthens equities while weakening safe havens. Tight money strengthens currencies while suppressing commodities. Industrial metals rise in expansion and fall in contraction. But look at what is happening now. Gold is rising despite elevated nominal yields. Silver is rising despite slowing global growth projections. Stocks in some regions are still near highs, while commodities surge simultaneously. These correlations should not coexist in a stable macro environment. When hard assets and financial assets rise together, it does not signal prosperity. It signals currency dilution. This is the same pattern that appeared in the 1970s, when inflation eroded the purchasing power of the dollar, even as nominal asset prices climbed. People believed they were becoming richer. In reality, the measuring stick was shrinking. And today, the measuring stick is shrinking again. This brings us to the most dangerous signal of all, the difference between nominal stability and real instability. Global debt has reached levels that would have been unimaginable a generation ago. By mid-2025, global debt exceeded roughly $340 trillion, several times the size of global GDP. Debt of that magnitude cannot be paid in real terms. It can only be inflated away. Central banks know this. Governments know this. Markets are beginning to sense it, and silver is reacting. Now we need to talk about the real cause. Most people think metals rise because investors panic. That is backward. Panic is the visible effect. Monetary debasement is the cause. Over the past decade, central bank balance sheets expanded dramatically. Liquidity flooded the system. Interest rates were suppressed for years, then raised aggressively, but the structural damage had already been done. Currencies today represent claims on economies drowning in debt. And trust, once lost, is never restored quickly. Central banks themselves are confirming the shift. Nations across Asia, the Middle East, and emerging markets have been increasing gold reserves and reducing dependence on the dollar. Why would they do this if the monetary system were stable? Because they understand what is coming. Silver sits at the intersection of two unstoppable forces, monetary fear and industrial necessity. Unlike gold, which is primarily monetary, silver is consumed. It is used in solar panels, electric vehicles, semiconductors, and advanced electronics. Industrial demand has surged so dramatically that supply deficits have persisted for years. This is critical. A monetary metal that is also an industrial input behaves differently in crisis. It does not merely store value, it disappears into supply chains. Now we need to talk about global confirmation. When a market is truly changing, the evidence appears everywhere at once. Physical premiums rise, delivery delays appear, arbitrage spreads widen, retail demand becomes price insensitive, inventories tighten. These are not theoretical conditions. They are already appearing in segments of the physical silver market, where dealer inventories tighten and premiums remain elevated, signaling that physical demand is not fading, even when paper prices swing violently. And this divergence between physical and paper markets is one of the oldest warning signs in commodity history. It appeared in oil before the 2008 spike. It appeared in gold before the 2011 surge. It appeared in copper before major industrial booms. The paper market reflects sentiment. The physical market reflects reality. And reality is tightening. Now we need to talk about something even more unsettling. Silver's volatility is not a sign of weakness. It is a sign of scarcity interacting with leverage. Silver is a small market. When capital moves into a small market, price moves violently. And when supply is constrained while demand accelerates, the violence intensifies. Analysts have already noted that silver's industrial demand, particularly from solar and technology sectors, has become dominant, while supply has struggled to keep pace. This is not a cyclical imbalance. It is structural. This brings us to the contradiction that few are willing to face. If inflation were truly under control, metals would not behave like this. If currencies were stable, central banks would not be accumulating gold at historic levels. If the system were healthy, debt would not be rising faster than output year after year. The lagging asset in this environment is not a metal, it is trust. Trust in currencies, trust in bonds, trust in the idea that central banks can engineer stability indefinitely, that trust is eroding quietly, invisibly, but relentlessly. And once trust begins to erode, the process feeds on itself. Investors move from bonds to equities, from equities to commodities, from commodities to physical assets. Each step is a vote of no confidence in the previous layer of the system. Now we need to talk about the psychology of this moment. Most people still believe markets are cyclical. They believe that after volatility, things return to normal. But what if normal itself has ended? What if the volatility is not a phase but a transition? Ray Dalio recently warned of a coming capital war, driven by debt, geopolitical tension, and declining trust in fiat currencies. Capital wars are not fought with tanks. They are fought with currencies, trade restrictions, and financial sanctions. And in such an environment, neutral assets, assets that are no one's liability, begin to matter again. Gold has already moved. Silver may be following. Now we need to talk about the final signal, time. Markets today move faster than at any point in history. Liquidity vanishes in hours. Prices reprice in days. Cycles compress into months. This acceleration is the defining characteristic of late-stage financial regimes. In the Weimar Republic, the final phase of currency collapse unfolded in less than 2 years. In emerging market crises, confidence disappears in weeks. In modern digital markets, confidence can disappear in minutes. And when confidence disappears, cash itself becomes unstable. Not because it vanishes, but because what it can buy collapses. This is the part most people misunderstand. Holding cash in a declining currency is not safety. It is exposure to a silent erosion. An erosion is more dangerous than collapse because it is gradual enough to ignore until it is too late. Now we arrive at the verdict. The signals forming in silver are not isolated. They are part of a larger pattern. Debt at historic extremes. Currencies under pressure. Central banks accumulating hard assets. Industrial demand colliding with finite supply. Volatility accelerating. These are not random events. They are symptoms of a system reaching its limits. You are witnessing the late stage of a monetary cycle that began decades ago. And cycles do not end politely. They end with revaluation. They end with resets. They end with moments that in hindsight appear obvious, but in real time feel uncertain and confusing. This is one of those moments. The old rules are fading. The old correlations are breaking. The old assumptions are dissolving. And silver, volatile and overlooked, may be one of the first places where the fracture becomes visible to everyone. Not all at once, but suddenly enough that history will remember the signs were already there.